Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're taking a look at what to expect from Disney, Roku, and Uber earnings, which are all due out this week. But before we get into that, I want to say, remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com. Also, make sure to subscribe and leave a review wherever you listen to your podcasts. And make sure to check out our new zacks.com/promo page for a look into some of our services, portfolios, and more. All right, so before we jump into what to expect from Disney, Roku, and Uber this week, I figured it's nice to get a broader overview of what to expect from the overall S&P 500 earnings, which is data we have at Zacks. So as of Friday, so last Friday, May 1st, the most updated results I've looked at, Q1 results we have for 277 S&P 500 members, or about 55% of the index's total membership. So of those 277 index members who have already reported, overall earnings are down about 13% from the same period last year on 2.1% higher revenues. And then if we look at the whole, so what we have seen already and what we're expecting Q1 earnings to slip about 12.5% on that overall 2.1% revenue growth. And then looking farther ahead to the second quarter is actually when we're expecting to see the worst of it, and hopefully the worst of this coronavirus economic downturn, which we're calling now for S&P 500 earnings to decline about 36.3% in the second quarter. So far worse than what we're expecting in the overall first quarter. So with that in mind, we're going to go ahead and start with Disney, because they're expected to report their quarterly results after the closing bell on Tuesday, May 5th. So if you're listening to this on Monday, that's tomorrow. And it's their Q2 fiscal 2020 financial results. And Wall Street will really be paying close attention to the entertainment conglomerate, because it's been pretty hard hit by the coronavirus since it's affecting large parts of its business, from its parks and resorts to its theatrical releases, which are two big chunks. So now we're going to dive into kind of what we know so far, and then we'll take a look at what to expect before we close out on Disney. So Disney was forced to close its parks in Shanghai and Hong Kong long before the coronavirus turned into a global pandemic. And since then, obviously, things have gotten a lot worse. They've closed Disney World in Florida, Disneyland in California, and worse yet, it's really unclear when its flagship U.S. parks will be able to reopen given the current social distancing push. And I don't even really want to speculate on what's going to happen with that at all, because really no one knows yet, even though you do see more state and local governments trying to reopen parts of their economy. But it does seem hard to think that you're just going to have thousands and thousands of people pouring into Disneyland and Disney World anytime soon. And then meanwhile, on the theatrical front, and movie theaters in particular are closed around the country. This has forced not only Disney, but most of Hollywood to either postpone or delay their release dates. So for Disney, it's postponed what we're expecting to be big blockbusters for them. That's Mulan, Black Widow. And this could then affect their schedule going forward. And this is also causing production delays, which then could affect things for maybe longer than people expect going forward as well. And then another thing that's being impacted at Disney, which sometimes I think gets forgot about, especially with all of their Disney Plus stuff, is that there are no live sports. So this is really negatively impacting ESPN. The NBA playoffs supposed to be on right now, which is a big thing for ESPN. They've spent billions on those NBA rights. So obviously bad things going on at ESPN right now, and it doesn't seem clear, once again, when live sports will be able to return to television screens anytime soon. So with all of that said, this does put a lot of pressure on its new streaming TV service. And investors should be happy to note that Disney Plus, and this is based on Disney came out and said that in early April, it had hit 50 million global subscribers, up more than 21 million since early February. And for reference, the platform officially launched in November of 2019, so last November. And so they're already at 50 million paid subscribers, which is really big figure for Disney. And obviously, it's still far behind industry leader Netflix. but these early numbers do show promise and its ability to compete alongside some other big name players in this streaming TV space that's going to only be growing for years, if not decades to come. So this is against AT&T, Apple, Amazon, Netflix, and others as well. But along with those production delays that are hurting their theatrical releases, this is also going to hurt Disney Plus programming. So you might see Disney try to push more things onto Disney Plus sooner than they would have. And things can just get a little crazy depending on how long Disney Plus isn't able to make its new shows, because unlike Netflix and some of these shows, their catalog was going to be based on putting a lot of new shows. So from Marvel and Star Wars, new programming on this Disney Plus, which now obviously production has been set back on that. So before we look ahead, it is worth quickly noting that Disney stock has bounced back around 20% from its March 23 lows, along with the broader market, but its comeback does lag the S&P 500's 25% comeback. So it's maybe nothing where investors are really thinking Disney's going to be in a better position, but it's just that the market's been really bought up since March 23rd, and they've lagged the broader market. So with that in mind, our current Zacks estimates are calling for Disney's Q2 revenue to jump around 21%, which might seem counterintuitive, but this figure is going to be boosted by the inclusion of its Fox deal in its Hulu ownership, which weren't included for the first time until Q3 of fiscal 2019. So for instance, Disney's Q1 2020 revenue, which is their last quarter, jumped 36%. Q4 jumped 34% in Q3 of 2019, which was that first time they put in its big Fox deal and its Hulu ownership, jumped 33%. So we're calling for a lot slower growth compared to those 3 quarters that included the Fox and Hulu ownership. We're calling for 21% growth compared to last quarter, which grew 36%. And then if we look ahead to the next quarter, Disney's third quarter revenues are projected to tumble 20% from the year ago period, which is including its Fox deal as well. And then at the bottom end of the income statement, Disney's adjusted Q2 earnings are projected to plummet about 49% to 83 cents per share. And then things, as we mentioned with the broader S&P 500, things are supposed to get a lot worse next quarter, with its adjusted earnings per share expected to fall over 107% to actually post a loss of 9 cents per share for Disney. And those are based on our current estimates. And obviously, Disney has been spending a lot of money on its streaming rollout, but these setbacks, even a giant company like Disney can't really fight off not being able to have its parks open and have its big programming on ESPN and its theatrical releases for that much longer. And then we should also note that Disney's earnings revision picture, and it seems pretty obvious, has turned far worse recently, with its estimates for Q3 down over 110% from where they were just 60 days ago, and its overall fiscal 2020 estimates down about 50% since then. And all of this has Disney as a Zacks rank number 4 sell at the moment, and its shares are down about 25% in the past 12 months. And Disney also fell over 3% in morning trading Monday to hover around 33% below its 52-week highs. And this might make some people want to scoop up Disney stock at a discount. And obviously, longer-term investors should maybe think about buying Disney at its current price, because it's hard to believe that in a couple of years from now, it won't look like you bought Disney at what would be a steal, since unless things go really, really bad with the coronavirus, eventually it will return to something close to normal within the next year at least, you would assume. So longer term investors might want to scoop up Disney, but if anyone has a shorter term investment horizon, they might want to wait until after the results come out on May 5th and you get some idea of when things might start to reopen and they can start to do return to production and any updates on their theatrical releases. And then with that said, Disney's dividend yield is actually resting below the S&P 500's average, and it sports Fs across value, growth, and momentum in our style score system. And it's part of an industry that sits in the bottom 36% of our more than 250 Zacks industries at the moment. So obviously Disney, not the best near-term outlook for the company, but longer-term investors might want to consider buying up this entertainment conglomerate. But once again, really pay close attention to their results tomorrow for any updates on what they see happening in the near-term future with the coronavirus and all of those setbacks. And now we're going to move on to a company that seems, unlike Disney, pretty tailor-made for the current stay-at-home environment, and that is Roku. For those of you who don't know, it trades under the ticker Roku as well, so that's ROKU. Its shares have skyrocketed 100% since March 16th and jumped another 6% Monday morning. So now the question is, maybe should investors consider buying the streaming TV company's stock before it reports its Q1 2020 results after the closing bell on Thursday, May 7th. And before we look at what to expect, it's time to just kind of dive into a broader, simple pitch of what Roku is offering investors. So Roku is famous for its small devices that plug into TVs. They allow users to watch streaming TV content from, say, the likes of Netflix and countless others that we kind of mentioned when we talked about Disney Plus. The company stands to grow along with the overall expansion of the streaming TV market. And last quarter, Roku predicted that roughly half of all US TV households will have cut the cord or never had traditional pay TV by 2024. So that's a pretty big figure that Roku is pointing to as why it could grow in the long term, as well as more and more people focus on streaming TV instead of that traditional paid TV. And then Roku currently sells multiple streaming TV players. It has also expanded its reach via smart TVs that have its operating system built in. So for reference, eMarketer said that Roku's portfolio of devices helped it top the category with roughly 44% of viewership for streaming TV content, and this beat out rivals such as Amazon Fire TV, Google Chromecast, and Apple TV's device, not Apple TV Plus, which is their streaming TV platform. So last year, Roku said that nearly 1 in 3 smart TVs sold in the US were Roku TVs. So with all that said, clearly Roku is a big streaming TV player, but more recently, Wall Street has turned its focus to Roku's expanding digital advertising business. And the company is really able to attract advertisers through its Roku channel that allows users to watch free streaming TV shows and movies. But on top of that, the company also sells advertising across its marketplace, which enables marketers to buy targeted ads on Roku's home screen and promote their own streaming offerings and whatever else. So Roku's bigger pitch now is that advertising and marketing ability. So overall, Roku's revenue climbed 52% last year, so in fiscal 2019, to about 1.13 billion, with its ad-heavy subscription-focused platform sales up 78%. So they were really driving that overall revenue growth for Roku. So now we're going to go ahead and take a look at what to expect and how the coronavirus might impact its Q1 results. So the coronavirus pandemic has obviously forced millions of people to stay at home around the world, and it's unclear exactly when things will start to return to something like normal, which is obviously good for companies like Netflix. We saw Netflix add nearly 16 million subscribers in Q1, which crushed its pre-coronavirus outlook. And with that said, you'd think that maybe Roku would provide more upbeat outlook for 2020, but they actually, on April 13th, withdrew their 2020 outlook because of all the uncertainty. So even a company that seems kind of tailor-made for the current stay-at-home environment, actually, there's so much uncertainty that they said they're withdrawing their 2020 guidance. With that said, they did update their Q1 guidance because they just have obviously a sense of what's happening since that's already over with. So the company said that they will have about 40 million active accounts as of March 31st, which is up nearly 3 million since December 31st of 2019, so up 3 million over that 3-month stretch. The company also projected that its Q1 streaming hours will jump about 50% from the year ago period, and it said that its revenue would be, quote, slightly higher than its prior outlook. So for Q1, they're expecting a slightly higher revenue compared to the pre-coronavirus guidance they provided. And overall, if we look, our current estimates are calling for Roku's revenues to climb about 44% this quarter, and then we're expecting its quarterly earnings to come in far worse. So last year they reported a loss of 9 cents per share, an adjusted loss of 9 cents per share. In this quarter, we're calling for an adjusted loss of 45 cents per share. In overall, we're calling for an adjusted loss in 2020 and 2021 as they're still in their growth phase, as they're trying to expand their platform revenue and grow internationally as well. So if we look ahead to the full year for 2020 and 2021, we're calling for about 34% growth this year and another 33% growth on top of that to get all the way up to $2.02 billion. So we're calling for 34% growth this year up to $1.5 billion, and then they're going to make another $500 million and jump all the way up to over $2 billion in 2021. So a little bit of a pullback from their big 52% growth in 2019, but back-to-back years of 33 and 34% growth is pretty solid and might make longer-term investors think about scooping up some Roku shares, which still sit about 30% off their 52-week highs, which could give the stock some room to run if it's able to impress Wall Street on Thursday, May 7th. And with that said, though, Roku is up big since it went public in around the third quarter of 2017. The shares are up about 415% since then. And they've had some up and down volatility during that time, but overall it's been a strong stock. And as I mentioned, they sit about 30% off their 52-week highs, which might make some people want to consider jumping into Roku. But as I would say, again, just like with Disney, amid all of this uncertainty, playing a stock just around earnings is not maybe the most prudent investment idea, but longer-term investors certainly should take a look a little longer at if they should buy Roku as a play on that longer term. That's one of the really only pure play streaming TV bets besides Netflix. So maybe take a look at Roku stock as well. And then we're going to close out with a look at Uber today. So Uber is set to report, just like with Roku, they're set to report their first quarter 2020 results on Thursday, May 7th. So that's after the closing bell as well. And right off the bat, investors should note that Uber in mid-April pulled its guidance, just like Roku, amid all of these coronavirus setbacks and uncertainty, stating, quote, "Given the evolving nature of COVID-19 and the uncertainty it has caused for every industry in every part of the world, it is impossible to predict with precision the pandemic's cumulative impact on our future financial results. As such, we are withdrawing our 2020 guidance for gross bookings, adjusted net revenue, adjusted EBITDA, which were provided on February 6th, 2020. So they're basically saying we have no idea what to expect from their bookings. As a person who used to use Uber all the time, I can say that I have not used Uber since early March, certainly not since mid-March. So I live in Chicago, and I know that you're seeing a lot less people obviously have any need for Ubers, because where are you going to take them? You're not taking them to the airport. You're not taking them to restaurants and bars. You're not taking them to visit friends. So a lot less people are certainly going to be using Ubers. So with that said, before we go ahead and look at what to expect, I want to take a quick look back to give more of a sense of what's going on at Uber. So Uber was founded in 2009 as a taxi-like service for the smartphone age. And at most point, people know what Uber is. It connects riders and drivers. Uber has expanded rapidly since then, from South America to Asia to Europe. And Uber went public basically a year ago. They went public in May of 2019 to much hype. And the stock has really failed to impress Wall Street since then. And their costs have really piled up and scared people away as well. So as you mentioned, Uber's losses have grown as it expands amid price wars against its North American rival Lyft, and in all these international markets it's trying to expand in as well. So to cut costs, Uber has laid off employees, and it's sold some of its divisions that weren't doing as well in international markets. And despite these efforts, Uber still reported a loss in Q4, which once again came in higher than the year ago period. So it reported a loss of $1.1 billion in Q4. But with that said, Uber executives at the time did update their profitability timeline and said they expected the company to be profitable on an adjusted basis before interest, taxes, depreciation, and amortization by the end of this year, so 2020, and not its previous 2021 guidance. But it seems hard to believe now that that will be able to be the case given the current coronavirus setbacks. And luckily, Uber is still able to operate its Uber Eats business, which is probably doing more business than it has done at any other point, as more people are getting food delivered as they're not able to go out to eat it all. So we'll see what they say about that on their Thursday report. But still, Uber Eats was a much smaller portion of their business than the actual core Uber business, where it's ride hailing all over the place. So now with that said, we're going to go ahead and take a look at our estimates. So for Q1, we're calling for its sales to climb about 7.7%, and its adjusted loss to grow, to shrink from the year ago period. So that's a positive sign, but we're still calling for an adjusted loss of about 89 cents per share. And then for the full year, at this point, we're calling for its sales to slip marginally, about 0.40%. So less than a half a percentage, we're calling for a decline. And then as of now, we're calling for about a 12.4% sales downturn in the second quarter, which is when a lot of businesses are hopefully expecting to see that worse impact of all of the coronavirus. And luckily, as of now, and obviously these estimates can change as Uber updates analysts with what they're really expecting going forward. As of now, we're expecting Uber's adjusted loss to come in far less than it was the year ago period. So we're expecting a loss of $2.70 per share, which is far better than the year ago when it had a loss of $6.81 per share. And then if we look ahead, we're calling for an even smaller loss that next year as well. So on the bottom line, things are actually moving in the right direction as the company and its CEO are trying to really focus heavily on cutting costs and not just piling on its losses as it tries to become a more mature business, since it has been around for over a decade now. And even though its earnings revisions have trended in the wrong direction, it's a Zacks rank number 3 hold right now. Uber stock dipped around 3.3% through morning trading on Monday to about $27.50 per share. And overall, the stock is still down about 35% since its IPO last May. So with that said, maybe longer term investors who are betting that Uber can really be the future of transportation, it can be the Uber of everything, might want to scoop up Uber for less than $30 a share. But with all of the three companies we talked about today, it's certainly maybe not the best near-term bet, but any longer-term investor might want to dive a little deeper into their business, as they could be a play on that future if you think that there's going to be autonomous vehicles driving people around and there'll be less car ownership down the road. But this is certainly another big week for earnings results. We had the big tech players last week: Amazon, Apple, Facebook, Google, and this week we have Disney, Roku, and Uber. So certainly pay attention to any and all updates, and we'll be back next time for another episode of Full Court Finance. So until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.